Stocks and bonds are both investments, but they're designed to do very different jobs in a portfolio. Most investors hear these terms all the time, but understanding how they actually work and why they're used together is one of the most important foundations in investing. Let's start with stocks. When you buy a stock, you're buying ownership in a company. That means you participate in both the upside and the downside of that business. Your return from a stock generally comes from two places. 1. The company growing its earnings over time. 2. Other investors being willing to pay more for that company in the future. Because of that, stock prices are influenced by many factors: earnings reports, economic conditions, interest rates, news, and even investor emotions. This is why stocks can be powerful long-term growth tools, but also why they can be volatile. Prices can move quickly, sometimes for reasons that have nothing to do with a company's long-term fundamentals. Now let's compare that to bonds. When you buy a bond, you are not buying ownership. You're acting as a lender. You are lending money to a company, a government, or another institution. In return, they agree contractually to two things. 1. To pay you interest, usually on a fixed schedule. 2. To return your original investment, known as the principal, at a specific future date called maturity. That structure is critical. Unlike stocks, bonds don't rely on market enthusiasm or growth expectations to generate returns. Your expected income is defined upfront by the terms of the bond. This is why bonds are commonly used for income generation, capital preservation, reducing overall portfolio volatility. That doesn't mean bonds are risk-free. They can still be affected by interest rate changes, credit risk, and inflation. But compared to stocks, bonds tend to offer more predictability and less price movement. So how do these two assets work together? Stocks and bonds are not competitors, they're complements. Stocks are typically used to drive long-term growth. Bonds are often used to provide income, stability, and balance. In strong markets, stocks may outperform. In uncertain or volatile periods, bonds can help smooth returns and provide consistent cash flow. This is why many well-structured portfolios don't lean entirely in one direction. They use a mix adjusted based on goals, time horizon, and risk tolerance. It's also why chasing returns without understanding the role of each asset can lead to poor decisions. A fast-moving stock and a steady bond serve very different purposes, and both can be valuable when used intentionally. Successful investing isn't about choosing stocks or bonds. It's about understanding what each one is designed to do. When you know the role each asset plays, you stop chasing headlines and start building strategy. Visit elcastilloinvestments.com to learn more and follow us for more financial insights.